Excellent. Thank you very much, everyone. Thank you very much, Sean. Greeting from a actually beautiful sunny day in Southern California. Again, we've been very blessed in many ways. Thank God we are all healthy, and there's a lot of things to be grateful. And one of the things I'm grateful is to our group. I just had a nice chat, and I really appreciate you, every one of you, to be part of our community. So. Um, with that, as always, as you know, we have our review of the economy today. What I'm going to do about the economy, basically, as always, we go over um, under the hood, I call it, but I'm going to talk a little about interest rates and the touch about inflation and how it's going to affect actually the upcoming year and many years to come. So it will be a little more of a educational side of the things, and hopefully then we can implement that. And we'll review the markets the week that we had and what to look forward to next week. And I do have few lessons of the week, and they are hopefully they are practical lessons that you can implement immediately. Again, it's something that with last 2 weeks, what happened with the we're talking about the Reddit and Wall Street bets. Maybe this lesson could be of help in the future. And there are a few other lessons in there. And then I will review a couple of my trades I did last week, which actually comes back to the markets, how I use the markets to my benefit to do a few of those trades. And as always, we look at the squeeze, the scan, and then we look at the upcoming earnings, and then we will open for Q&A. All right. So with the economy, basically last week being the first Friday of the month, we had the non-farm payrolls, the employment numbers. They came right around. It was expectation was about 50,000. It came at 49,000. The unemployment is about 6.7, 6.5%, which I don't really put any value on those numbers. The U1, I want to look at the 6. I want to look at um, there's a lot of about 425,000 discouraged um, job seekers. They're out of, they just gave up. So those numbers really don't mean a lot. It's a good, just a good conversation piece. So, and the unemployment numbers actually came worse they had to adjust it for December. On the other hand, the initial jobless claims, as you can see, came at 779,000, which was, it was an improvement from the previous week. Um, Still, we have a large continuing jobless claim. So that's continuing. I like the staffing report. I want to see what is happening, if there's any new openings are happening. And, we, um, again, with a lot of discouraged employees, um, this is, it's a good level. We are going to see, obviously, when April comes, these all numbers are going to completely change. So, but again, I want to see if there's any trend, and the trend for me is these weekly, week over week. The box office don't mean anything. People have become again more efficient. Watching the Super Bowl has always been great. Maybe now they're paying. I guess you can watch the same thing with soccer. You have like your own specific box online with HBO and the way they are coming with the movies instead of the theaters. So people are getting adjusted. So I don't know how much this is going to change, but I know people still like to go out. Um, the other thing is the hotel occupancies. One thing is interesting that the revenues per available room has been improving, but again, not all the rooms because of the occupancy. You can see that the level is still very low. The same thing with the flights. And so these are the things we look at under the hood. So we are, again, right now, the whole thing is improvement with the COVID vaccination. We've talked about Johnson and Johnson. It looks like, well, it's a one-shot deal. Now it's like about 85% success. No refrigeration, which is great for the third world countries or developing countries, getting the things to them. So that's improvement. Obviously, it's good news. It's the transportation, how fast they can produce, how fast they can send them. So these are the questions. The logistics are the problems. On top of that is this week, as you know, a lot of markets hit all-time high, and everything like Thursday and then Friday morning, if you recall, Senate decided to pass, or they actually, with President Biden's blessings, they're working at that $1.9 trillion stimulus, which came to 50-50 in the Senate, and Vice President Harris was the breaking vote advantage. So markets love that. They can, they can smell it. They can see, well, there's more money coming. President Biden said, regardless of whatever happens, they're going to go that $1,400 extra check. So that's what the markets are looking at. There are a couple of unknowns that, about, again, we talked about the variant. We had the South Africa variant, and then we have Brazil. And then, of course, we have the UK B117. So these are like, they are the United States. It looks like the South Africa and the Brazil is much smaller than anticipated, but it's still the beginning. UK is, the B117 is developing. So I've said it before in the last 2 weeks, I think March will be the time, maybe middle of the March, to see really if the effects are going to take a hold or not. So with the stimulus package, again, there's that hope, there's the vaccination, the opening the economy, there's that positiveness. So obviously the market's loving it, and that's what they were reacting to it. They feel that reflation is back. All the companies that, they were unloved, they're being loved again. But there's a couple of issues that we have, and I'm going to tie them together. Number one, looking at the 10-year notes. So interest rates, we look at interest rates, and where the Fed has control, obviously they do the Fed rates, which is the very short-term rates. And I want to look at, this is something for the past year. And in August, we discussed it. I think we went down to 0.52% 10-year note rate of interest. And that's what basically your mortgage and refinancing rates are based on. Interesting thing is, as you can see, we have been in a uptrend, and we just hit a little under 1.18%. So what that means, still, is fantastic to have a 1.18% on a 10-year note. The question is, the debt service, if you're thinking about the government debt service and other things, it's more than doubled. So we came from 0.52 to 0.11, to 1.18, almost 1.17, almost 1.18%. So this is a little concern. So what the markets are telling us is, and this is where we go back to the education we talk about, when you're analyzing the markets, you look at risk on assets, you look at risk off assets. When risk on, that means, well, take a chance. We look at the stock markets, the S&P, Russell 2000, NASDAQ. We look at the Aussie dollar. We look at crude oil, for instance, and then transportation, financials. Then the risk off, on the other hand, we're looking at the treasuries, for instance, gold to some degrees. We look at Japanese yen. So this is the VIX, the volatility. So when you always weigh these things every single morning that you wake up, then you understand that, okay, the relationship is there. And one of the relationships is obviously the interest rates. So what is interest rates are seeing that maybe the markets are not taking into account, or if they're taking into account, how they are behaving regarding that. So I'm looking at this 10-year note. Then I went back. I've reviewed this maybe a couple of times in past year with you. This is, it goes back all the way to 1985. I looked at, obviously, if you recall, in 1980s, in the beginning, we had a very high interest rate. the mortgage rates, I remember, I did buy properties then, it was like 15, 16% with the mortgages. The interest rates for just borrowing, because I had to borrow to go to school, I was paying 22% interest to um, to pay for my school. And now you see a complete trend. We've been trending down since 1980s. We hit, and it's been a beautiful trend line. And every time we hit the top of the channel, we've come to the bottom of the channel. We briefly, if you notice, we broke it, and that was when Chairman Powell came and they were going to increase the rates, and the market had immediate reaction. And that was that December debacle when the markets really dropped, and we finished 2018 down 6.5%. But look what happened. The yield went up and hit the 200-day moving average, and it came down. So we've come down, and that's what August, and then what happened in March, and then in August. And now, basically, we've been creeping up. So right now, we're at the 20-day moving average. What does that mean? From technical point of view, maybe we'll have some rest. And the next slide, what I want to show you is, we talk about Fed, the monetary control that Fed has. So Fed basically does two things. They want to have the price stability using the interest rate control, and they want to have full employment. So those are the two main jobs. Based on this, I want to see that this is what is today, the current situation with our yield curve. And yield curve is basically, we look at the yield of every single, the treasury bills, the short-term rates, to 10-year notes, to long-term bonds, for instance, 30-year, and we look at the yield. So obviously, the steeper it is, that means a big difference between the long-term bonds and the short-term notes or the bills. So what you could see, this is from 2019. So you could see that it was pretty flat for the 5-year. And after that, it went up a little bit. And then we were at like a 3.1% for 30-year bonds. What we see here is after 10-year, the yield today is higher than what it was in 2020's February yields. So right now, we are actually, for 20-year and 30-year, our interest rates are higher. Now, the question comes into picture, so what does Fed has to do with it? Well, that tells us you can see up to 3 years, there's not much movement. And then after 5 years, we have this steep movement. What that means is Fed really doesn't have a lot of control on the long-term rates. So what they have control is basically trying to control the Fed, and basically they can use the reserves, and basically that's how it dictates the rates. Now, the question will be, obviously the fiscal policy have more effect, and that's what I'm looking at, the stimulus package. So it seems like the long-term bonds are telling us, well, maybe it is inflationary, because the value, with all the printing the money, the value will go down. It was interesting that last week, actually the dollar did go up. So that was because of a hope of, again, with the vaccination and the growth in one way. On the other hand, it is the stimulus, depending on how much it is, obviously it's going to affect the dollar. So regardless of that, I'm tying in this interest rates with the inflation numbers, which are going to be the next step. But what does, in 2 or 3 minutes, let's see if the Fed has control over short term, do they have control over long term? The short answer is yes and no. What they did, the long term is not the job of basically the Fed or any central bank. What it is the job of the markets. And that's why there's a lot of risk. If you purchase a 30-year bond, could be a lot of volatility. So what Fed can do, that's why the term that you've heard, the quantitative easing, in order to Fed to do something, they have a large reserves, bank reserves right now. They have quite a bit. So in order to control, and let's say they don't want these yields to go up, every time they can come up with this targeted, we call them the yield curve, and they say, you know what, we don't want any, for instance, 10-year note go more than 1.5%, or the 30-year note going more than 2%, because that could be very dangerous. And it's not just our Fed, the central banks around the world have learned this, from Euro to Reserve Bank of Australia, for instance, they kept it at 0.25. They have come up, these ideas are very attractive. So what do? They actually, basically what they do, they can purchase those bonds. So rather than the market buying them, what the Fed can do with that, all the reserves that they have, they, every time the yields are going up, they can go and purchase those bonds and keep the yields down, and nobody can compete with them. And basically what that, the dangerous part, it will be an artificial way of controlling the yields. Granted, it's, the markets like it in some ways because now they know there's steadiness, but also it stops the free market, capital markets working. And I use Japan as an example. For instance, Japanese market from the 1990, they have tried everything, and they are trying to create inflation. They, no government likes deflation. They want to pick up the growth. And in 2016, for instance, the Bank of Japan came and they decided to do the 10, have a target of 0.25 on their 10-year notes. What that means is every time that the rates go above that, they're going to come and repurchase that. And they're controlling the yield curve that way. Now, what does that mean? That means if I am a bond trader, I'm a big, again, fund or a commercial entity, and I want to be involved with the bonds, if I know the government is going to get involved, I'm not going to get very active. So in Japan, you will see that there are days, 6 or 7 days, that there's no activity. The bond traders are not in it. And that's the dangerous part. As a matter of fact, just recently, the Reserve Bank of Australia, they decided to do the 3-year note to tied, I believe it was 0.3%. So they decided, well, this is a good way of controlling the yield. So this is what the Fed can do. But at the end, you can go back to Japan. That hasn't really worked out. Although, again, Europe, I look at like Italian bonds, for instance, you know, for past 40 or 50 years, we've had 29 different governments in Italy. The latest one is, looks like Mario Draghi is, you know, the head of, before this job was with the head of the Euro. Here he comes, and he can say, oh, you know, Ms. Lagarde, can you just purchase our bonds? So basically that's just takes care of the free market. So with that in mind, if we're going to have this, and if the markets smell that the yields are going up, what can we do? How does the inflation going to play a role? And that's my next slide. This is the CRB, which is the Commodity Research Bureau Index. And basically that shows us, this basket has, you know, from different elements from agriculture to energy and precious metals. And anyway, this is one of them. Bloomberg has its own. So there's 3 or 4 different, S&P has its own. So we do have these available. CRB is the one which is mostly most accepted one. As you can see, this is where we were. And then obviously the COVID happened and then we really dropped. We are back, then we just closed above the 200-day moving average. This is on a weekly basis. And you can see we've had this big move, especially since November. And again, why is that? Again, the idea of the, you know, Democratic win, and basically then coming with this big stimulus package. Now we're talking about infrastructure spending, maybe $1 trillion, which I have no problem with it. The question is how it's done. That tells us that there is this inflation pressure. So how we can take advantage of that, and that's what I've said it before. I think in the past 8, 9 months we've been talking about. I think the decade of 2020s, it will be a more favorable decade for the commodities, and that's what I'm hoping for you to get as educated as possible with the commodities, understanding them. As a matter of fact, I thought it would be a good idea. We will have a class this coming Wednesday, basically talk about inflation and talk about the few big commodities, just refresh your memory and how we can take advantage of it as a vehicle, because it looks like the cycle is coming back. And I just want to give you, the reason why it could be a play. And one of the biggest reasons is, of course, it's the interest rates. All right. So I spent a lot of time on the economy side, but I thought it's very important for you, hopefully, have a little better picture of what's going on with the interest rates. So let's go to the markets. As always, it's interesting. We look at the sentiment, and this is the CNN Fear and Greed Index. And last week, just a week ago, how things can happen so rapidly. Last week we had the fear of 35. Immediately again, I don't really care about the middle. I like to see the extreme. So when it gets to the red or like really green, that's what concerns me. So something in the middle is not a big deal. But you could see how we went from 35 to 60 at no time. The Citigroup, the panic euphoria, is still in a euphoria zone. So there's still a lot of optimism. On the other hand, the American Association of Individual Investors, they've been kind of quieting down after hitting one of the highest numbers since November, actually at 45.2. Now they're settling in an average, which is usually about 38%. So these are more of the investors, and these numbers are, the question is how the markets are going to be, where are they going to be 6 months down the road? So that means 37.4% of these surveyors, they said the market will be up 6 months from now, and 35.6% said the market will be down. So these are just more of a sentiment. Again, when we look at these things, we want to look at extremes. Now, last week, when we look at the markets, again, tale of two cities in a sense. Like last week, if you recall, almost everything was down 3.5%, 4%. This week, all positive. From Dow Jones Industrial, almost up 4%, to transportation being 5.8%. And then we go all the way to S&P 500, 4.65%. NASDAQ was up 6%. And the star was 7.7% was the small caps and Russell. So again, a big twist. And once we look at the charts, that might answer why this happened. Obviously, again, the stimulus package coming in and then the Senate accepting it, that obviously played a big role. So this is where it gets interesting. Advanced decline line last week, the advancing issues were 700. This week, 2,800. Declining issues were 2,500. This week are 459. So one theme, again, I go back risk on, risk off. Look, the dollar was up a little bit, and we will look at the chart, see what is the direction next week. But the T-bonds, they actually sold off, and that goes back with the yields that we were talking about. So that's risk off. So that's down. The crude oil actually broke through the resistance again with this vaccination. That's played a role. So what happened? The crude oil was up, risk on. The inflation numbers, they actually have been creeping up, and we just looked at it at 181.39. And then gold, which is interesting because it is part of obviously the Commodity Research Bureau. We want to see what happened now with the interest rates going up. You have to remember, gold is a non-interest paying asset. You have to pay for storage. So when interest rates start going up, well, it affects gold. Also, the dollar went up, so it affected gold. But I did have a trade on gold, and I will tell you why I did that. But here, gold was down. So those are in the numbers, and let's look at it quickly. I will review the our chart. So the Bollinger Bands, if I've said it once, 10 times, 100 times, please pay attention for these Bollinger Bands, because they do give you at least a target, or at least give you the idea that where the resistance will be. And last week we were here, we talked about, oh, this is where we ended, right at the lower edge of, this is S&P 500 cash, right at the lower edge of the Bollinger Band. And my comment was, we have to see what's going to happen Monday. Monday is very important, because usually what happens when, especially with big assets, when we hit the lower edge of the band, a lot of put sellers, they come in, they stop the bleeding. They don't, unless there's a really a big event which is going to push it down. At least the sellers, they step aside. They don't want to sell during the lower edge of the Bollinger Band. And lo and behold, although we were down, again, this was right at the edge. So we had one down, and this kind of went up to the edge. This was down. And then, as you know, I have my two confirmations. We bounced back, and look what happened the next few days. We were oversold. We were in the stochastics. We never got embedded. And so that was S&P 500. And it's a similar, it's a similar chart for the S&P futures, except we kind of violated on Monday, we violated the lower edge of the Bollinger Band, and we bounced back. Now we are very close to what? Upper edge of the Bollinger Band. So this is food for thought. We are 2 days in, so we are not embedded completely yet. So we are 2 days up. So if Monday finishes up 3 days, then we are embedded. That means that buying pressure is still on. But if we turn around and come back down, what that means is usually it goes from the upper edge of Bollinger Band, it will go to at least to the 18-day moving average. The story continues the same way, because the NASDAQ did the exact same thing. It was only down 1 day below 18, and we mentioned that we'd like to have 2 red candles below the 18-day or any moving average that we are looking at for our confirmation. As you could see, it reversed immediately Monday, touched that lower edge of Bollinger, and now we are close to the upper edge of Bollinger Band. Russell 2000, exact same story. We touched the lower edge of Bollinger Band, and now we are touching the upper edge of Bollinger Band. The weakest one was the Dow Jones, and you can see again that went to the lower edge of the Bollinger Band. We are not quite up in the upper edge. It has been weaker. The other ones, transportation, hit the 100-day moving average, as you can see. And what happened was it bounced back, the lower edge of the Bollinger Band. It was oversold. It didn't get embedded and immediately turn around. And now we are just sitting on 18-day moving average. So I will watch that for Monday. And I want to look at the weekly on transportation. So what you could see, transportation tried to break down below its 18-week moving average, and it just bounced back. So although we are not embedded, now we are overbought. So we have to watch the transportation for this coming week to see how it's going to behave. Now the stories turn. There was a conversation about VIX. This was one of the biggest moves in VIX in a long time. And you can see it went outside the Bollinger Band. And the question was, again, usually VIX does not like to stay outside this Bollinger Band more than 1 bar. And guess what happened? It went back up. This was one of the fastest moves I've seen. We went from like 38 or so down to 20 and at no time, 22 or so. So it's like there was a big drop. So basically the drop in VIX that gave you the indication that the markets are going up. and you could see we were overbought. We never got embedded, and this is what happened. So that's why it's important to understand, again, the relationship. This is risk off, risk on. So watching VIX, and then we look at the VVIX, which is the volatility of VIX. So why is that important? For instance, what that means is if you are, let's say you want to play options on VIX and it's right all the way up here, and in the previous one, let's say it's here, then I go and see, my God, implied volatility of VIX is pretty high too. Now, one of the things I could do, strategies, maybe I could sell credit or do like a vertical spread and maybe sell a VIX like above here. Why is that? Because the volatility of VIX, first of all, VIX is, I know VIX is outside its bands, so that means there's a good chance it's going to come down. On top of that, I know the implied volatility of VIX is outside its band. So it's a double whammy. So I could, by selling it, by contraction, by slowdown of the volatility, I can collect a premium just from this, but also from actually dropping the price. So I could have sold call, naked call maybe, or I could have sold vertical credit spread on this, a call spread, and collected the premium in two ways, knowing that there's not a good chance it's going to go and hit that, for instance, that target, whatever we decided to do on VIX, and knowing that, again, the volatility of it is coming down. So this is one way of maybe if you want to play VIX, that will be something. Now, on the other hand, now we have really slowed down. Look at the candles. So for me, 110 is a big number. So we are at a little under 110. So right now, there's like stability is coming back. We like to see this Bollinger Band flattening. Now, if you want to have insurance, and we go back to this VIX, we'll see we're way off this band. So if you had confirmation and you want to maybe buy VIX, this is a good time maybe start buying rather than selling because the volatility has contracted. So maybe you can buy options on VIX right now, but don't be a seller of VIX. So just again, strategy. So how you can implement just by looking at Bollinger Bands, having a strategy for yourself. Now, the other question is that the dollar, as you know, the dollar had a nice run, but guess what happened? Again, we hit the upper Bollinger Band and we got really close to 100-day moving average. And that's what Friday, we actually had a little sell-off. So this tells us that now the buyers have stepped aside for now in the short term because it hit the Bollinger Band. And maybe there is a selling calls going on, at least for short term, to go to at least to 18-day moving average. So we can use this. If there is a weakness in dollar, maybe we can translate it to gold or any maybe silver, any other commodities. But right now, it looks like there's a little resistance in dollar. So watch this on a daily basis. On the other hand, the crude oil had a very strong move. It stayed right above its 18-day moving average, and then we had a nice breakout. So we've been, again, with the crude oil, once it gets the momentum, it's similar to gold. Once they get momentum, they can stay outside Bollinger Band, but I've not seen anything over 5 days unless there's like, again, huge COVID event. It happens that it just continues. But generally, statistically, you can't be outside. So right now, maybe crude oil might be getting a little tired, although we are embedded. So, and RSI is strong. So we will watch crude oil. I want to look at the weekly on the crude oil. If you recall, last 4 weeks, we've been hitting our head against 100-week moving average, and we just broke above it. We are embedded on the stochastic, so that means there's still strength, and mainly again it comes from the demand side. Now, one of the things also you have to remember, one of the reasons the crude oil is up is also the inventory numbers came in. A lot of these oil companies are having difficulty, and because of not another big movement, now we can see that the green energy is alternative energy, clean energy is a big theme. President Biden has emphasized that. So a lot of these oil companies are not even fixing their refineries if there is anything to work with. So we're going to have, there's going to be shrinkage of supply. So that's what the market is also looking at. And that's what I would look at the BHI, Fridays when they come as far as the number of the drilling going on. So that's important to know. Gold. So this is what happened with gold. Again, last week we were here, there was a support. Guess what happened? We went and broke through the Bollinger Band. This was my support. And on Friday, we bounced back up, still not inside just trying to get inside the Bollinger Band. As I mentioned again, this is the time usually the put sellers come into the picture. And again, the sellers kind of step aside. They don't like to touch the Bollinger Band, especially the first time. And the put seller is trying to collect the credit. So this is the reason we had a bounce. So it goes along with obviously with the dollar weakness. I want to look at it on a weekly basis. Again, we are very close to that. Again, touch the Bollinger Band on the weekly. But look what happened. We got rejected at 18-week moving average, and we've been just all under the 18-week moving average. Now, on the other hand, let's look at silver. Now, silver, I was joking last week. I said, well, these Wall Street bets are going to push the silver up because silver was up nicely on Friday while gold was selling off. And then, lo and behold, on Monday, guess what happened? We had this crazy move, which was the highest in about 30 years, 30-year high, not inflation adjusted, just on the absolute numbers. So that was really interesting that it went outside its Bollinger Band, and guess what? It sold off. Now, the difference between gold and silver, and I've been talking about silver for quite some time, is silver, I believe, is undervalued compared to gold, but also silver has other industrial usages, especially if the economy starts growing. And we have the solar panels, we have the cars and technology. So because of that, it's a kind of a different, we have to have different perspective to silver. The good news is if the gold goes up, usually it takes silver with it anyway. So silver has been, I believe it's a better play for me as far as maybe, as far as going long for a long term. And as you can see, again, we are way above 100-day moving average and way above, we were way above 18. And then, as I had mentioned before, anytime we go outside the Bollinger Band and we are overbought, the silver or any asset likes to come back to its 18-day moving average, which it did. And it just stopped right at 18-day moving average. Bitcoin, the same thing. You can see with Bitcoin, remember we had the 5 days or 4 days outside the Bollinger, 5 days actually. And then we just retraced, came inside, and again, it's the bands are narrowing right now. We touched the lower Bollinger Band, we were oversold, we bounced back. Copper, I mentioned last week. Now, copper is going to slow down because of the Chinese New Year. And yet on Friday, you see that's nice bounce. I believe the main reason for this, as you can see, it's a very narrow range. And I think the copper was taking into account the Chinese holiday. But Friday, we had a nice bounce back. And I believe the reason for that is the infrastructure package that President Biden and Democrats are putting together, and I believe that the Republicans are going to go along with it. So there's going to be a package, which is good for copper, and I think that was the reason for Friday. As I mentioned, I don't believe there's going to be a lot of demand coming from China at this time. So anyway, that's for copper. And the news is natural gas. We've talked about natural gas in the past. So right now is the weather related. sometimes we have very unusually warm weather, and then we've had really unusually cold weather with the snow back in Northeast, and then obviously we've had it in Chicago. So again, you can see it had a nice bounce, and then we go outside the Bollinger Band and we come back down. This is crucial. We're about 100-day. So what's going to happen with the winter getting almost over? So we still a weather pattern. Then we're going to look at the future, the summer demand, the heat wave and other things. So in between, we're going to look at, this is going to be also oil play, whether there's enough refineries. Remember, we are exporter of natural gas, but with the, again, disruption in supplies, how it's going to affect natural gas. I would not play, if you're a futures player, I play that, but I would not recommend it, because like silver is it's a big contract and very volatile contract. And I go back, if I go back to silver, because I think it's a good educational moment for silver. So let's say you were a buyer here and you're so enthusiastic and you decided to go, man, this is great, I'm going to buy it. Just to move from here to here, about $3, it's, each contract is $5,000, just one contract. You would have lost $15,000 in a matter of a day and a half. So that's what I do not recommend. That's why these ETFs like SLVs are attractive. The same thing with the natural gas. I will kind of stay away from it, but you can play UNG and there's a few others, but it's just a food for thought for the NG. A couple of more last ones. The financials, again, double bottom in a sense. In a sense, we touched the Bollinger Band twice, and then we bounced back. And as soon as the first objective, when you hit the lower Bollinger Band, is going back to the 18-day, and we did that. And now, again, increasing rates, good for the banks. So basically, the spread is higher for them, the profitability, and that's what you can see. The last but not least is Nikkei. Very slowly has been moving up, and now we're just hugging our 18-day moving average. Okay, so let's talk about expected move, and I think this is where the concern was, the question came, and this is on S&P. And as it was said earlier today, was look what happens. Usually it has been pretty orderly. I mean, if you were playing options, and again, option makers they plan. I mean, I will be following, except this day. Remember, we had like the volatility from the election and all that. Other than that, we've been pretty orderly till last 2 weeks. Last week, if you notice, the previous week to last week, 2 weeks ago, we actually tried to hold on to the lower edge of the Bollinger Band, and I mean the expected move, and then we broke down right there. On the other hand, this week we hit against the upper edge of the Bollinger Band and we broke above that. Now, you can see in the last 10 weeks, we had pretty orderly movement. So why did this happen? And basically what this tells us, that there is this volatility underestimation, or we call it the squeeze, is going on right now, that it's making the option makers not take into account. And what that does, this volatility of the movement. So it's not, the easier way I can tell you, like last week, our expected move was 132, and we moved up, but the movement was 169. So this expectation has expanded. We call it megaphone. This week, on the other hand, they've really narrowed it because the volatility really dropped. We're at like 65. Historically, what happens when we go back pre-COVID, if you looked at it, usually there's that uncertainty about the markets. That's usually what this does. It tells us the time like this, when we go outside these ranges, there is a good chance we can continue, and I'm talking about SPX, and you will see in the other indexes as well, but like with the S&P 500, there is a chance till it kind of slows down. There's a good chance that we're going to violate our expected move till it gets back to its normalcy. So it happens once, it's okay. You know, it happened 2 weeks ago. But when it happens 2 weeks, just be watchful of that, especially if you're playing options. The market's still uncertain about things. So that's S&P, but the same thing happened on NASDAQ and QQQ. Again, we went outside and then we went on the downside for NASDAQ, we've had 3 weeks so far. So that the second week, we thought it might be anomaly because just barely did. Friday we had the sell-off, and then guess what happened? This week we had the same thing. So just be watchful of that. The same thing with IWM. IWM last week, and then this week it's been, I think we had 1.5 standard deviation outside. The Dow Jones Industrial, the same message. And then we go to 10-year note. It barely, now this one has stayed within its range. We barely went outside. So, 10-year note, we had that big sell-off. Again, most likely because of the stimulus package. Gold, we went outside and then we snuck in. So gold has been, again, I usually apply those expected move mainly to the equities. It happens with commodities. You can see a lot more often things are going outside its range. The same thing with silver. Look at what happened with silver. That big move. Whether you want to blame it on, I don't know what it was. I think some people really took advantage of, the rumors, and they started pushing the silver to sell it. So then basically I look at emerging markets. Emerging markets also are volatile. They go once in a while outside. So this was a play again with all the markets. We had 3 weeks in a row. And then the financials, look at what happened. Financials, again, 2 weeks in a row, outside and outside. So we, hopefully next week we get some settlement in a sense, but just be aware this could happen. It's all about probability. So granted, if there's 10 weeks, well, 2 weeks like this happen, you just, have a tight stops, or just make sure you're proactive with these if you're playing expected move. Remember, it's a 68%, so it's not 100%. Energy had an interesting, actually, 2 weeks. So we went outside and then we had a nice bounce back outside from the upper edge. And I thought I will just put Amazon in here. They came with their earnings. They had a nice jump, and then the next day they just corrected, and then they're trying to sneak back. Okay. All right. I hope it's been informative so far, because I want to spend a little time on the lessons that there, but maybe 5 lessons. But I thought it's timely again with what happened with GameStop. So I thought maybe talk about a little about trade management, money management, especially if you have like some crazy stocks. Some people had Teslas of the world, Amazon of the world, Tilray, they all the cannabis stocks, or maybe you have Bitcoin stocks, such as blockchain stocks like Riot or Mara, and these are the things. So I thought it would be timely maybe talk about a little bit about. Again, this is the way I approach it. You can decide the way you want to do it, but it has worked for me in the past, so I just want to share with you. So let me start sharing with you first that GameStop's crazy 2 weeks. I mean, it was crazy few weeks, but till the second week ago, we thought this is crazy. So we were talking in the class, we the subject came and the GameStop was about $65. And I thought, this is madness. And, it could go up, but like anything else could come down. In my wildest dream, I never thought you're going to see, believe it or not, they say about 484 or so, 488, but I saw pre-market was 513. So GameStop hit 513. So this is 2 weeks ago. And this is this week, this past week. So if you were on vacation and let's say you looked at GameStop and then went away and came back, well, nothing. They just neutralized each other. You would have said, oh, it wasn't, wow, GameStop's at 65. That's great. They never sold it off. But if you were in the markets, this is not even day to day. These are like minute by minute. It was pretty exciting. So with that in mind, I thought, let's say last week's one of you, just either one, you just said, I want to be on the bandwagon. I think this is going to go to the moon, one of the lingos. So I'm going to get on GameStop and you buy that $100. So how would have you done your money management with this? Granted, you could say, you know what, 100, it's going to go to 1,000. I have no doubts. So this is the way I approach it. One of the things I've learned over time with my trading strategies, and that you have to decide how much of a value and capital is for you time-wise versus actually hitting your profit target. What I mean by that is, would you rather make 25%, let's say in a week, or you would wait and say in a year, I would make 50%. This is very important. And you have to analyze in your mind that which one is important to you. So with that, it's more of like a time targeted profit rather than absolute number profit. The reason I say that, I say, all right, if I made a profit next week on this holding I have, and I made 25%, and I got out and I have this capital available to do something else and something else, is it better for me? Or maybe you've done complete research on something, it is a small cap, unknown, no research on it, and that's different. It's like a buy and hold, you really believe in it. Although sometimes there are things that I really believe in it, I always like to take some profit just to have the cushion. So this is a decision you have to make. I've learned by taking the 25% in 1 week, it gives me psychologically, it gives me that security and freedom to take actually a little more risk, believe it or not. Also, I think what it is, it's just emotionally, it's very rewarding to know that, I don't want to call it's like you're a winner. All right. That's one of the reasons a lot of people stay in the trades, because they don't want to be a loser. So this just subconsciously, it gives me that little encouragement and enthusiasm to stay, to do something else. So with that in mind, I want to share, like, for instance, my silver trade that I've had. And I've had silver, and I got to more silver. You know my feeling about silver. So I thought silver was very undervalued. So I got into SLV about $12. It was March 23rd. I got into that about 1,000 shares. So it's a few shares, about 12. But if you notice, all along the line, I've been selling a little bit at a time. And when I saw this madness and you can see we are way outside linear regression, and it happened sometime in summer as well. And what I've done, I decided I still am holding, and I do have options on it, by the way. I have long-term leap options on my silver, and this is one of my accounts. But I said, there's nothing wrong, absolutely nothing wrong to take some profit. So I sold some, and I still have some. If it hits the moon and it goes to 1,000, so be it. I still have some exposure. If it doesn't, I took some of my profits, and I'm happy about it. So this is the strategy I want to share with you. And how do you manage your profits? How do you manage if you had something like Tesla? And I know there are a few people who are big believer, and they got in, and God bless them, they made millions and millions in Tesla, and that's wonderful. The same thing with Amazon and Apple. But the psychological, this roller coaster is, we're talking about 5 or 6 stocks versus a portfolio of, when we talk about 10,000 stocks. So they are not just, few stocks that everyone owns. There's some other trades that you will get in. So let's assume you got into GameStop and you bought 100 shares at $100. Let's just leave it at that. So the way I do it, I will have a target increment. Increment. And what I mean by that, my idea about my option strategies. As soon as I get into my options, I do have my profit target immediately set. So I know I will be happy to take 1/4 out at 25%. I'm happy to take 50%. I'm happy to take sometimes 75, sometimes 100, and then I will have one little one left as a runner most of the time, depending on the options that I'm using. If it's like one day, sometimes I'm not that greedy and I will kind of try to get as much profit. But majority of time, let's say this is just in stock. So let's say we play GameStop. If your profit target was increment is 25%, what that means is you are going to have 25% target, 50% target, 75, 100, 125, 150, and so on. Just every 25%, you want to take a profit. So they add up at the end. So let me use an example. So you have 100 shares, you have a 25%, and your idea is I'm going to take 1/4 of my shares every time I make 25% increment. So you have $100, 100 shares. The 1/4 of 100 is 25 shares. So as soon as my target is hit at 25%, I sell 25. Then I have 75 left. As soon as I hit the next 25%, which is a 50%, I sell another 1/4, which is 19 shares. Now, in this situation, I've left with 56 shares. Out of 56 shares, let's say I'm up 75%, then I'll sell 14 shares, and so on. Then I have 42 shares left, and out of that, let's say 10 or 11 shares if I hit 100%. The idea is, granted, the stock could go to 400%, and believe it or not, even if it did go to 400, I might have 1 or 2 shares left. But something, if you would have done this target just from the beginning, let's say you did it with GameStop, you probably would have been left with 1 or 2 shares today at a loss if you thought you didn't have any stop loss, but you would have gotten out at least 2 or 3 or 5 shares at $400, at $450. I don't know. I mean, I haven't calculated, but this is one way of, again, if you're in a volatile stocks, or you have stocks that you think is going to move really fast, and it's something that you really believe in. Again, Tesla is a good example. So granted, I wouldn't have had 100 shares or 1,000 shares in Tesla, or maybe Bitcoin. I always share that story. I mean, owning Bitcoin at $32, if I had a strategy that maybe I would have 100% or 50% targets, and I probably would have been left with 2 or 3 coins left. I had 1,000. No, I had 300. So basically, with those coins, if I had 3 or 4 left, at 40,000, that's not a bad return. Rather than I just got out of everything when it was up, I think 300% or so. So, but that's one thing. So let me give you another example. Now, if your profit target is higher, you really think, again, let's say think about AMC or Nokia, or COS, or again GME. They say, no, I want to take 50% profits. So the higher there is, you should take more ratio of, you should redeem more percentage of your profit. So if it's 100 shares and 50% of it is your profit target, then I will take like 1/3. And then that means I'm left with like 67 shares. Then I will take 22 shares when it hits 100%. Then I take 16% when it's 150%. it's, it all depends on your personality. You don't have to do this. This is just an idea that I've done. There are a lot of times that I've regretted it, but most of the times I've been happy that I did it because it just released something so I can do something else. So the idea is just growing your portfolio, whatever it takes. So I've said it before, nobody gives you trophies, nobody gives you awards, nobody gives you licenses or certificates for making 1,000%. What you do at the end of the day is how much your account has grown. So, all right, I hope that was helpful. So let's talk about next lesson. And that's, how I feel about Bollinger Bands. We use it obviously in the squeeze. So I don't know if you use something called Bollinger Percentage Band. Because I'm visual, I don't need to look at it, but I thought sometimes it's very difficult to see if the Bollinger Bands are, if the stock or the asset went above the Bollinger Band or below it. Is there any way visually we can see it? And there is analysis indicator that you can actually just add to your, this is from TradeStation. I have an example from like Thinkorswim. So basically this is from gold futures. And as you can see here, I'm visually looking at it and I see, oh, it touched that Bollinger Band. It's right here. What this does, this percentage, if you add this, it shows you between 100 and 0 with 50 in the middle. So 50 is the average, is the mean, the mean. And then if it's 0, if it goes below 0, that means you're outside the Bollinger Band. And you can see there was one here, there's one here, there was one here, 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 and then the one we had last week. So if you notice, there is, every time it goes outside, and here it went outside from top, every time it, went outside the Bollinger Band, it reversed and it came and hit, actually, that usually goes to the mean. This time it actually went and hit the lower Bollinger Band. Immediately it hits the lower Bollinger Band, it goes outside of it. As you can see, there's these little, it goes below 0, it bounces back, goes to the 50-day. So basically, and we have it here, I just don't want to bombard you with a lot of different ones, but if you like to add it as an extra indicator, if you play Bollinger Bands a lot, you do a squeeze, but if you want to see visually, okay, this is a lot easier to see. Okay, we are outside of it. So the odds are more than likely that it's gonna, like here, we actually had a support at 100-day moving average on top of that. So that was a nice indicator that maybe you should go long. The same thing I did that with, and this is on S&P. So you can see the same thing. This was, this was when it goes below 0. This is above 100. So that means it goes outside. As you can see, as soon as it goes outside, it reverses back to the mean and then goes to the lower. And then the same thing here. Here was actually below 0, and then it went back up. So just knowing that as a strategist added benefit, I thought visually it might be helpful. On Thinkorswim, all you have to do is, again, you go to edit style, for instance, just add, and just type, and that's the beauty of Thinkorswim. You just put Bollinger Bands and it will come, and then it says the percentage. It's a little different with Thinkorswim. You can actually change it, but if you don't, it still has the 0, 100. It has bars, so every time it goes over 100, like for instance, you see here, that means it's touched the lower band. And I did put down the Bollinger Bands here, and you can see actually we're getting the squeeze here. And anyway, I just thought to share that with you. I'm going to go a little faster of interest of time. But the next thing is, just as you know how I feel about Finviz. Finviz offers you so many different things. So one of the things is they have a map, and every week it's a nice idea if you want to look at the stocks of S&P 500, you want to look at the ETF, you want to look at the international. Just visually, by looking at this, you can say, okay, great. So look at all these greens. So there's a little harmony. So there was a big week for for instance, Google and Amazon and Apple. And the bigger the box is, you can see, that's their market cap. So the bigger the box, the bigger the company. So you can see Apple, Microsoft, and Amazon's are the biggest, and it's Google. And then Tesla is getting there, and Visa and JPM. So, and then you see in the healthcare, my goodness, there were quite a few reds. And the lighter the green, the higher the rate, as you can see here. So that means the more return, the lighter the red, the most loss. So basically, I just thought this takes you maybe a few minutes, but it's a good place to maybe do your research for the following week, especially if there's anything earnings coming up. You're looking at this. This tells you like a lot of your FANG stocks, 1, 2, 3, 4 FANGs, and Tesla. You can see all the 6. They all had a nice return. That helps to explain why NASDAQ was nicely up. That explains why S&P was nicely up. You know, all these stocks were up. So that's another one. Just a short one. This is from stockcharts.com, which is, again, free. In the past, you've seen, I look at the part of S&P. I want to see what percentage of the S&P stocks out of 500 they're above the 200-day moving average. Again, I look at the extreme. So this is a weekly chart. So you can see about 90% of stocks are above their 200-day moving average, 90%. Now you can see what happened in March. We were like only 1%. So these are extremes. And that told us, well, we are really oversold. And here it looks like, again, for the past since November, it's getting a little overheated. So it can stay overheated. Usually like to, you know, area like this, 50, once we break about 50-day moving average, it's a good area to get into, start, you know, watching the stock. There's still room to go. But this is like once a week. If you want to look at some extremes, this might be an idea. That doesn't mean that the markets are going to crash or go down, but you know, it's been a lot of stocks are moved above the 200-day moving average, which tells us strength, but also are we getting overbought? The last but not least, just being on the theme of last 2 weeks, I thought just in case if you go on Reddit, just thought to share some of this vocabulary. If you're not familiar with it, I just thought, you know, I love 7, so I thought, let me give you 7 words that they use. So they use apes, and I'm not in anybody, I don't even tweet. I do have a Twitter account, but I don't really, I'm that much on social media, but that I thought it was interesting. So apes, referring to all members themselves, they call themselves apes. Bag holders is when people who are holding that fallen stocks and they're gonna hold it as long as it takes, and they're not gonna sell, and they're gonna take the losses, whatever it takes. Daddy, they call the Fed chairman Jerome Powell is called Daddy. Diamond hand is they're gonna hold that winner, the position till the end, no matter what. So you see a lot of no matter what. I think they should take our trading psychology class and trading plan, because life doesn't work that way. But that's a commitment. So that's what they want to do, to show attendees is really money made, profits made, whatever. It's more like a money. So they call it attendees. To the moon is the profit target. Usually it's very high, so they call it to the moon. And YOLO is you only live once. So what that means is, hey, don't quit. You gamble big and just keep doing it. And anyway, just a food for thought. So I thought that was interesting. So just the trade of the week, there's a couple of things. Every week I'll go through this. Just we had a class 10 days ago. I thought to share that with you. You can see this gap didn't work. Interesting enough, in IWM, it has been working. So it's interesting. This is S&P 500, but IWM has been, you know, the Russell 2000 has been a hero. they've been filling their gaps, at least half a gap. One of the things is if you go back, this was like filling the previous week's gap. So it was interesting that we filled the previous week's gap. Here we filled half a gap. This is Fridays, and the Friday you can see immediately we filled the full gap, and then after that we stayed within our range, and it just usually, you know, um, about 60% of time it stays within its range. So it did respect that. And then again, the previous day we respected the lower edge, and then we broke above the upper edge. So respected that. So just a food for thought. I do futures based on that. So I talked about gold and silver, and basically what I do every week, I do a trade, try to do on a specific day, usually Thursdays, Wednesdays could be good. But we talked about those Bollinger Bands, respecting them. And remember, trading is probability. So I could have been wrong maybe 20%, but I took a chance. So what I did, I bought the gold 167 and a half option. This is the 30 minutes. Immediately I put, again, this is Thursday morning, and I kind of spread it. I wanted to, there was some weakness. I want to get a better price. So I just, every 30 or 45 minutes, I just bought one or two. And then I put my targets. You know, if I do something else, immediately the next day, they all got hit. Granted, they went even higher, but so be it. I made my 50 to 75% average there. I did another one. This was it was out of money actually. I did a 169. It was cheaper, but the same thing. You can see that they all hit their targets, and basically I had one runner, and that's why you can see I didn't sell it here. I put a runner, and then eventually it hit me at the end. So it would have been that, or I would have been assigned. So I just got out. So that was my goal. But for the first time, I also, not the first time, I usually do, my weekly is gold, but I thought, well, let me play, you know, weekly silver. And they worked out really good too. Again, based on the charts we looked at. So I did a 23 and I did a 24 call silver, and timing was good. We hit our targets. Could have done obviously quite a bit better too, but so be it. This is actually, this one worked even better, the in the money. So, and there were nice profits for one day, not even one day, because I sold them like early in the morning. So the reason I shared this with you, so I do have a daily gold trade, but also because of, again, Bollinger Bands, looking at that, and I thought that was a good time. Scan for squeezes quickly. This time I decided, again, there's NASDAQ 100. Last week, I believe we did the S&P 500. So there's some good stocks here, just a food for thought for you to see. I don't have, my apologies, there's no, you know, headings here, but by now you know there's a technical and fundamental, and then the total. What is so when you see the green, just think it's good news. So anyway, last but not least, still in the earnings season. That it's been pretty good earnings season, and basically there are quite a few coming up. Tuesday we have Cisco, for instance, Lyft. We also have on Wednesday we have Uber, and well, Callaway Golf used to be such an interesting one. We have GM before, Coca-Cola, but Thursday is the one everybody's looking for. Disney, especially with the governor, I guess in California, there's a rumor that we could open the park. So it'll be interesting to see how Disney is approaching, and then PepsiCo. GoDaddy used to be interested to play that, Kellogg's. And then Friday before open, you have Moody's and a few others. So these are just some ideas for you. One of the things we talked about earning plays, my favorite day of the week for earnings, if I had to choose one, will be Thursdays. I love Thursdays after hour earnings because you really don't, it expires the next day, so you don't have that much of a theta play. So if it's going to work, it's going to really work well. If it doesn't, then you know. So you're not paying, the other elements are not there. There's no gamma play. So basically, not that much. So basically, I love Thursdays, and to a lesser degree, I love Wednesdays, but I really like Thursdays. Mondays are look too far out, because there's that, again, the theta and the premium play. So sometimes for the earnings play, when it happens, and let's say I want to get out of it the next day, it went my way, I don't collect as much reward and premium as I do, let's say, with the Thursdays and Wednesdays, but mainly Thursdays. Anyway, just want to share with you. As always, I want to share some of these, the volatile stocks if you want to play with. iRobot is really interesting. So Robos, the cleaning floors kind of, it's an interesting company. And the rest, you can just, these are just ideas for you for a coming week. And with that in mind, I appreciate your patience. And yeah, it's it was a little longer than ever, but I mean, previous classes, but I thought it was important. So, Sean, we can stop the recording and go to the Q&A.
Sure. Yeah.
Thank you so much.